Hello everyone, Stuart MacArthur here, Head of Sales and Marketing at Cooee Group. Thank you for joining us. I have Andrew Grinsell, Head of Wealth at Cooee Wealth Partners with me here. Hello Andrew.
Hi Stuart.
Look, we'll get started. After a decade of low interest rates and soaring equity markets, the rapid interest rate rises of 22 and 23 have ramped up the returns available from fixed income investments. In today's webinar, Andrew will guide you through the world of fixed income investing, covering, let's flick it to the next slide, what fixed income investing is and how it works, why fixed income is becoming an increasingly popular asset class, different types of fixed income investments, the role of fixed income in diversified portfolio, and Cooee's approach to fixed income investing and how it can be a benefit to you. For those who are new to Cooee, I'd like to give you a quick overview of the group and the collective expertise that brings. Imagine navigating a world of financial journey with clarity, confidence, and a trusted partner by your side. That's the Cooee Group difference. We are not just another financial services provider. We are a collective of passionate experts dedicated to one thing: helping you achieve your financial goals, whatever they may be. Think of us as your financial co-pilot. We specialize in wealth planning, mortgages, accounting, and property strategies. What sets us apart, a lot of people do ask, is that we collaborate seamlessly. Our different specialities work together, which is all about offering a truly holistic solution. We tailor our approach to your unique needs and goals. Everybody's different, and everybody has different needs and goals, so we need to tailor our approach to those. We bring experience. Our qualified specialists are here to guide you every step of the way. We value transparency. Open communication is key to always knowing what's happening, and we keep you informed every step of the way. Before we do get started with this presentation, and it may sound like a pretty dull topic, but it's very exciting at the moment. Thanks, and Andrew will be taking us through that with a bit of passion, that's for sure. But before we do that, I do need to read through this disclaimer that we have here. The information presented in this webinar is for general information purposes only and should not be considered as personalised financial advice. It does not consider your specific objectives, financial situation, or needs. Before making any investment decisions, you should consider seeking professional advice from a qualified financial advisor who can take your individual circumstances into account. We recommend that you obtain financial advice specific to your situation before making any investments or insurance decisions. Please note that part of the past performance is not necessarily indicative of future results. Any investment involves risk, including the potential loss of principal. Investment involves inherent risk, including capital loss, volatility, liquidity risk, inflation risk, credit risk, intrinsic rate risk, currency risk, regulatory risk, and economic risk. So I guess, Andrew, we're going to hand over to you.
Yeah, excellent. Thank you, Stuart, for the introduction there, and thanks to everybody for joining today. As we go through, if anybody has any questions, there is a Q&A tab in Microsoft Teams, so feel free to drop those questions in, and Stuart will go through those and ask them at the end. So yeah, by all means, any questions come up, just drop them in. But look, let's jump in and get started with why fixed income is becoming increasingly popular with investors. On the screen now, we've got two different charts. So the one on the left with the orange bars takes us back to the end of 2019. And what it does is it shows us the income on offer from a range of different investments. Now, at that time, a portfolio constructed of high dividend yielding Australian shares was giving us income of about 5.5% per annum. You could put together a portfolio of US shares and that would give you about 4.7% per annum. But outside of shares, we were looking at generating income of anywhere between about 0.8% per annum up to 2.7% per annum from fixed income investments, which really wasn't much to get too excited about. However, when we jumped forward to the end of January 2024, You can see we've got a lot more investments sitting there that are providing us with returns between 3.4 up to 5.3% per annum, in addition to what we can get in shares. So what that means is we've got more opportunity available to us now to generate income from fixed income investments. It just quite simply wasn't there back in 2019, or what was on offer wasn't really enough to get us too excited to go too heavy into the asset class. We can also generate higher income than what we're seeing in the chart on the right by stepping further up the risk spectrum to generate more risk, more return when we start looking at things like high yield debt and private credit. And we'll have a bit of a talk about that later on in the presentation. Another reason why we're seeing an increased focus on fixed income investing is really just the current valuations that we're seeing in equity markets or share markets. So we discussed these tipping point tables that you can see on your screen now during last month's webinar. If you haven't had a chance to watch that one, you can jump onto our YouTube page and watch the recording. But look, at a high level, what it does is it shows us where equity markets are currently trading with the red arrows, and what that means in terms of whether or not they are either cheap, fair value, fully priced, or overpriced. Now, what we can see with these is that nothing is particularly showing up as cheap. Australian equities are at fair value, albeit at the upper end of fair value, moving into fully priced. Developed markets, so that's your United States, Canada, Europe, we're looking overall at those markets being overpriced currently. Emerging markets, a little bit better, sitting back at fair value, very similar to what we're seeing in Australia. Then we've got A-REITs, which is real estate investment trusts. So like your Centros, Mirvacs, Goodman Property Trusts, those kind of businesses, sitting in that fully priced range. So what that means is there's not a lot of really cheap or attractive opportunities in share markets right now. It's not by any means necessarily overpriced across the board, but it's also not terribly attractive. So when we move along and we have a look just a little bit deeper within the developed markets, it's not all bad. So what we actually see is this page shows us the breakdown between developed markets, US equities, the rest of the world, excluding US equities, and emerging markets. And you'll see that really where that overpriced part of the market is the US. We are a bit more confident on places like Europe and then emerging markets. So within our portfolios, we do adjust for that. But we're not here to talk about equities today. The main point behind this is that when we don't see a lot of opportunity in equities, we're going to end up with more allocation to other areas, and fixed income is one of those areas we're looking at. All right, so just moving along, and before we go too deep into it, let's just have a look at what the basics are of fixed income investing. So at its core, fixed income represents a category of investments that are designed to provide consistent income. Bonds are the most common type of fixed income investment, but we also have hybrids and then other structured products like asset-backed securities. A bond is essentially just a loan. It's issued, so the borrower could be a company or a government, and it's financed by an investor. So what happens is the issuer or the borrower promises to repay the loan at a future point in time. That point in time is known as the maturity date. The investor, they'll receive regular or fixed income payments, as well as the return of their original investment when the bond reaches maturity. Now, these bonds could be issued by companies, governments. When governments borrow money, it's typically to fund various ongoing budget requirements, such as infrastructure, defence spending, and public pensions. These sort of bonds, government bonds, are seen as being a relatively low risk investment. Then we've also got companies that issue bonds for numerous funding needs. So these corporate bonds tend to be less secure than government bonds, but the returns can be higher. All right, so let's just illustrate how a bond works. So let's imagine that you are an investor, and what you're doing is you're providing a loan to a company or a government. The amount you've lent to the borrower, known as the bond issuer, is the first bar on the left-hand side. So initially, you're outlaying an amount, an investment. In return for providing the loan, the borrower agrees to provide periodic interest payments. These are called coupons, and this is the amount shown in orange. And that occurs consistently throughout the period or the term of the bond. And those payments can be of different frequencies. They might be annually, quarterly, monthly, really depends on the individual bond and the terms of that bond. Then what happens is the issuer or the borrower agrees to repay the loan amount in full at a specific future date, which is the bar on the right. So this structure that you can see here, it mirrors the core elements of most fixed income or bond investments. In the investment world, you can lend money to governments or companies, including banks. When you buy a bond, you're essentially just loaning money to the bond issuer. In return, you get your regular income. The benefit for investors is really that the amount of money you get back regularly is fixed from the start. So this means you know exactly how much income you'll receive throughout the life of the bond, which makes the investment more predictable than what we might see in, say, shares, where dividends can be increased, decreased, cut, these sort of things. Whereas a bond, that can't happen unless the borrower defaults. So it's just got a bit more consistency and known outcome to it. All right. One of the things that we do need to be aware of when we're starting to invest into bonds, especially those issued by a company, is the way that the bond can sit in a company's capital structure. Each position has a consequence for the risk, but also the reward that the investor has. This capital structure is legally binding, and what it does is it shows us the priority of payments if a bond issuer or a borrower goes into liquidation. So what we have here is at the highest rung on the ladder must be repaid before any of the subsequent rungs receive their funds. So therefore, the lowest risk position is that's at the highest point on the chart. Investors that hold senior secured bonds must be paid back before any other bondholders, and the bonds are secured over specific assets of the company. So they're asset backed, they're securitized. These different levels of risk and return, really the key message here is that it provides us with the opportunity to structure a portfolio for clients with different amounts of risk and return based on the return objectives and the risk tolerance of the investor. It gives us the opportunity to go and stay right in secured debt, lower risk, lower return, if that's what clients are comfortable with and they don't need a high return, or we can move our way down the capital structure to chase higher returns, but with that comes higher risk, because if something goes wrong, those higher risk positions in the capital structure are the last to get repaid. We've got to just find the right mix for each client. All right, this chart gives us another way to look at risk and return. What it really does is it's quite similar to the previous slide in that it shows us how risk and return increases as we move along the capital structure of a company, but it also shows us where government bonds and high yield bonds sit in comparison. So just another little point here is that you might have noticed that bank deposits is actually showing as lower risk on this slide than senior secured debt, whereas on the previous slide it was the other way around. And that's because when you have your money in an approved deposit-taking institution, you do have a government guarantee up to the first $250,000 per account holder per institution. So it does just shift it a little bit in this context. All right. So when we're looking to invest into bonds, we've got one of the core choices is, do we want government bonds or do we want corporate bonds? So when we have a look at these, they've got different levels of yield. Now, let's just talk about what yield means for a moment. Quite simply, yield is just a measure of the returns available from a bond. So if we had a 10-year bond and it costs you $100 per bond to buy it, and that bond pays a 5% coupon, that means you're getting $5 per annum. That's a yield of $5. $100 in, $5 return, 5% yield. In the solid blue line, we can see what the yield is on government bonds. And at the moment, sitting just above 4%. We can see back earlier in 2023, we were down as low as 3%. If I took this back 10 years, you'd actually see that where we're sitting over the last 6 months is the highest level of yield we've had in this asset class since 2013. Above the blue line, we've got the orange line, which is the yield on Australian corporate bonds. So that means we're moving away from the relative safety of government bonds and moving into companies, where we're getting about a 5.8 or a 5.9% yield. So that means for every $100 you invest into a bond, we're actually getting $5.80 of income. So we can see we've got a different level of income between the relative safety of government bonds and then corporate bonds. The difference between the two is what's known as the credit spread. So it's the extra income that investors are looking for to be attracted to invest into companies as opposed to governments. So ordinarily, if you've got two investments that are of equal risk, one was paying a higher return and one was paying a lower return, of course, you'd go the higher returning one. But because the government bonds are lower risk, they don't have to quite pay as much to attract investors as what, say, a company might do. The other interesting point I just want to make at this stage is we've got a dotted blue line here, which is actually the RBA cash rate. And what you might see is there's a bit of a correlation between the RBA cash rate and bond yields, but what's actually happened after the last interest rate rise in October 2023, RBA cash rate went up, but bond yields went down. Reason behind that is that the bond yields are forward-looking. They're looking at the expectation of where interest rates are going to be over the next 5 to 10 years, not where they are just today. Just want to quickly touch on credit ratings, because what this does is it gives investors an indication of the risk they're taking. So these companies pay credit rating agencies like Standard & Poor's, Moody's, Fitch to have their bonds rated. Just on a side note, this conflict of interest where the bond issuers or the companies are paying the rating agencies is largely responsible for the problems we had in the GFC, where some of the AAA rated securities defaulted, even though they should have been the highest level of safety or the lowest level of risk. Anyway, the higher the rating, the less interest a company needs to pay, or the lower the coupon needs to be. Conversely, a low rating, which means a company that's got more of a chance of defaulting and not meeting its obligations, is obviously going to have to pay more to entice investors to take that risk to get that return. So I won't go through the definitions of all of these, but you can see there's quite a layer here. I've actually cut this chart off halfway down. It goes all the way down to D, which basically means they're on the verge of default. And then we have NR, which is not rated as well. But most clients will see invested around the BBB and above, and maybe just a rung or two below. We don't tend to go down much further than that. Another quick concept we just need to be aware of when we are looking at investing into bonds is that the value of a bond can fluctuate throughout its life. So rarely will they continue to trade around their initial issue price of $100. And the main reason behind that is that the movement in value is going to be in response to changes in the interest rate environment, overall economic conditions, and the risks of a particular bond issuer. So obviously, if a company's health deteriorates, you want to try and sell your bond in that company, it's going to be a bit of a hard sell to try and get somebody to buy that off you if that company's got an increased risk of default. So you might have to start offering it up at a discount to try and entice investors in who are willing to take that risk. So if bonds can't change their coupon amount, so that means if you bought a bond for $100 with a $5 coupon, that coupon can't change. The only way that a bond can move based on changes in yields is for the value of the bond to move. So the coupons are always fixed, but the value of the bond can move. So if we go back to that example that we were talking about earlier, where we've got a 10-year bond and we might have bought it for $100, it's got a 5% coupon rate, so we're getting $5 of income every year. Let's imagine that interest rates move to 6%. Now, because that coupon rate on the bond is already fixed at 5% or $5, that bond will have to drop in value to come into line with the current market rate. So what that means is the bond would actually have to fall from $100 of value down to $83. So you can actually have a loss in the value of a bond. Now, what that means is if we're getting a $5 coupon on an $83 bond, or that's the value of the bond, we're still getting 6% because $5 over 83 is 6.01%. So that brings it into line with current market rates. Now, if interest rates actually fell, let's say it went the other way, we went from 5 down to 4, the price of the bond can go up. It would actually have to go up to $125 so that it's carrying a 4% yield. Now, I've massively oversimplified the equation here, but the whole point of this is that when yields go up in the market, the price of the bond falls. When yields come down, the price of the bond goes up. And it's an important thing to be aware of because back in 2022, when interest rates were rising quite rapidly, yields were going up really fast. So the only way those bonds could really adjust to the current market environment was to drop in value. But as I said, it is an oversimplification of the equation. A better way for us to actually look at it is what we call yield to maturity. Now, that actually tells us the total return that you would get if you were to hold your bond to maturity. Because we go back to that previous example, if the bond fell to $83, still at maturity, you're going to get your $100 back, provided the company doesn't default. So when we're investing for clients, we're actually looking at this concept of yield to maturity, as that's the total return you would earn as an investor if you hold that bond until it matures and you get your principal back. And that concept of yield to maturity takes into account the coupon payments, so the regular income you receive throughout the bond's life, but also the capital gain or loss. So that's the difference between the price you might have paid for the bond and its face value at maturity. So if you bought a bond for $83 and it matures at $100, that's obviously, quite attractive because you get your income payments and it'll come back up in value. So it's a better way to look at things. So look, the key point here is that even if your bond price goes up or down due to changing interest rates, if you hold the bond until maturity, you'll get the original investment back in addition to the coupon payments. So it's just a much more complete way of looking at things. All right. Now, I think that's enough about how bonds work, and hopefully everyone's still awake. I know it's quite a technical subject, so hopefully you're all still with me. What I want to do now is talk about why we bring fixed income assets into client portfolios. So look, we've spoken about it previously. Shares do offer the potential for higher returns. We've seen that with what we saw in US equity markets last year, but they also come with more risk. And this is why we bring fixed income into a portfolio. It brings down the risk of a portfolio. When we blend fixed income with shares, we've got to think about it as being on a spectrum. On the one side here, we have a portfolio that's 100% invested in shares. And you'll see here that it's sitting quite high on the expected rate of return, but also its variance. So that means the amount that the returns can swing up or down every year is quite varied. Now, what happens over time, however, is as we blend bonds into the portfolio, the risk and the return comes down. So we hit a point where we get to about 30% shares, 70% bonds, and then it actually kicks back the other way. We're having a bond-only portfolio. We start to take on more risk and less return. So what we've got to do for our clients is really just find that sweet spot, and that's what's called the efficient frontier, and that's what we've illustrated on the screen here. So what we're doing here is we're just finding the sweet spot for clients between risk and return, and we've got 6 portfolios at Cooee that sit at different points along this risk and return spectrum. All right. I will say, however, that it's not just stocks and bonds that we put into portfolio. Just for illustrative purposes, we can further enhance that when we add other asset classes as well. So here we've added alternatives, which we do have in our portfolio, and you'll see that it also can increase the risk and reduce the return. The previous slide was an oversimplification of just stocks and bonds. We go a bit further than that with our client portfolios. All right. Let's have a look at how we're actually handling this at Cooee Wealth Partners. Now, this slide, very similar to what I presented in last month's webinar. However, what I want to just focus on this time around is fixed income and how it fits into our model portfolios. Now, with fixed income, what we've done here is we've broken it down into two broad categories. The first one, which is just labelled as fixed income, is the more defensive side of fixed income. So they're the secured debts, the government debts, the investment grade debts, so your AAAs, AAs, A-rated, really lower risk, lower return investments. And what you'll see on those is we're holding in our portfolios anywhere from 25% weighting in the conservative model, and then it comes down as we get to the high growth model where it only comes down to 2%. We then have the high yield debt. So what we're talking about there is the unsecured debt, the lower rated issuers, those who have got a higher level of return and higher risk. When we go through those, we start at the conservative model portfolio with 27%, and we run that all the way down to 9% in the high growth model portfolio. So you can see there that really, if we combine the two together, fixed income accounts for 52% collectively on the conservative model portfolio, down to 11 on the high growth model portfolio. All right. And that really is just coming back to that efficient frontier, the risk and return that we're trying to manage for clients. Let's go a step further. Let's have a look at what that looks like in the different areas. So on the screen now, we've got a breakdown of the actual holdings within this fixed income asset class. Now, these do change regularly for us in line with changes to the economic environment, assess risk out there, the potential return, and really the role that these investments play in the context of the total portfolio. Now, we've got an investment committee meeting scheduled for tomorrow, and it's likely that some further changes will be made to this mix. Probably not going to change the actual underlying investments, which I'll dive into in a moment, but we're likely to change the weightings to these investments off the back of tomorrow's investment committee meeting. So what you'll see here is that obviously we have things like the, you can see that it really runs down. We've got 5 investments that we hold in the conservative model portfolio for the fixed income exposure. And then by the time we get to the high growth model portfolio, we only hold 3. And that's just because it gets a little bit crowded if we're trying to put 5 fixed income investments into the high growth model portfolio where the total allocation is only 11%. If we try to split that across 5 investments, we're going to end up with 2.2% into each one, and it just doesn't really work well when it comes to rebalancing and trading in and out of those investments. So we narrow it off as we get out to those higher risk, higher return seeking portfolios. All right. What I'll do now is we'll jump in and actually have a look at these actual funds that we have in the portfolios. So first up, what we're running with is the Vanguard Australian Fixed Income ETF. Now, what this does is it provides investors with low cost, diversified exposure to Australian corporate bonds. It invests in investment grade bonds issued by big corporations like Australia's 4 largest banks. Actually has some offshore banks in there as well because they come into the Australian market to borrow, and some other lending institutions and property trusts. So as I said, it's investment grade. That means we're sitting at BBB and above on the credit ratings. The average is actually A+, so it's quite a highly rated investment. When we use something like VACF, it means that our clients have got bond exposure across 171 individual companies. So that brings the risk down a lot compared to going out into the market and trying to buy an individual bond and hoping that that issuer does not default. Right. So what it means is if any one company fails to make its coupon payments or return the capital to investors, the actual financial impact for our clients is going to be quite limited. And once you spread it across the rest of the portfolio, it really reduces the risk. Now, this particular fund currently has a running yield of 3.9%. So as we spoke about earlier, all that means is that it's taking the current coupon payment and dividing it by the current yield of the bond. It's a simple calculation. It doesn't consider that if you hold the investment to maturity, you get back the original or the face value of the bond. And that's why we use that yield to maturity concept that we spoke about earlier. So it takes both the running yield and any capital gains into account if you hold the bonds to maturity. And what that does is it increases the yield that investors, or the return that investors are going to get from this portfolio, up to 4.87% per annum. All right. So this is at the lower risk, lower return end of the fixed income spectrum. Next up, we move into the Schroder Absolute Return Fixed Income Fund. Now, this one takes a bit of a unique approach to income generation. Unlike the Vanguard fund we just had a look at, which holds the bonds to maturity, Schroder actually trade through the market and actively manage their securities. So they will buy and sell depending on where they see opportunity and mispricing. And the way they do that is they've got quite an experienced team of managers across a broad range of domestic and international fixed income investments. So it covers government bonds, corporate bonds, and even a bit of FX or currency trading in there as well, where they can pick up some extra return. Now, they strategically use these investments to capture opportunities across the entire fixed income spectrum, and they can actually profit regardless of the way the market's going. So look, one of the key benefits of the fund is that it's really focused on absolute returns. So it's striving to deliver consistent positive returns for investors over rolling time periods, regardless of what the broader market's trying to do. Really focuses on capital preservation. It gives monthly income to investors. There is some overlap in that with the Vanguard Australian Corporate Fixed Income Fund, but that's really just a reflection of Schroders having quite a positive view on Australian corporates. And on this one, we're getting a yield to maturity of 5.1% per annum. All right, we'll step it up a bit and let's step into the higher risk side of things. So here what we've got is quite a unique fixed income opportunity, which is the VanEck Global Capital Securities Active ETF, so GCAP is its acronym. What it does is it's a professionally managed strategy, and it's focused on a very specific segment of the fixed income market. So it's a very niche fund, this one. And what it does is invest in what's called capital securities, and they're a bit of a hybrid breed, which combines the characteristics of what we see in both bonds and shares. So when we look at that capital structure that we saw earlier in the presentation, the more secure, lower risk, lower return investments are up here. These guys are playing down in the subordinated debt and hybrid side of things. So they're stepping up into a higher risk area. And what that means is it's yielding, or it's got a yield to maturity of 6.83% per annum. So again, we've stepped up a level. All right. Then moving on, we have the Metrics Opportunity Trust, which provides our clients with exposure to quite a broad portfolio of private credit investments in the Australian market, provides consistent monthly cash income. 61% of the portfolio is allocated to those lower risk senior loans, but then what they also do is they build on the risk and return opportunity by moving more into the lower rungs of the corporate or the capital ladder by getting that subordinated debt and senior loans and subordinated debt and equity-like returns into the portfolio. It's also investing in companies that are a bit lower in terms of their credit rating at a BBB-, but it is spread across 159 companies. So the individual impact that would arise if any one company were to experience an issue will be fairly limited. Targeting 8 to 10% per annum net fees, which is quite attractive considering it's lower risk than what we would see in equity markets, but providing quite a comparable rate of return. So again, it's one that we quite like, and as you can see, higher risk than the 4s and 5s that we get from, higher return than the 4s and 5s of the Vanguards and the Schroders, but again, with higher risk. Last but not least, we've got the Global X USD High Yield Bond Fund. A bit like Metrics, this fund's investing below that BBB credit rating, but it's doing it in the US market. So what we need to think about with these sort of investments is that, they shouldn't be viewed as low risk investments, but they still carry less risk than owning direct shares. Overall, when we bring this into a client portfolio, it helps us target the right level of risk and return. And as you can see there, it's mostly sitting sort of below that investment grade, but as a consequence of that extra risk, we're getting that extra return at about 7.69% per annum. So look, hopefully that gives everyone a good overview of what we're doing within fixed income investing on the Cooee model portfolios. This topic was brought up in relation to a lot of questions that arose out of last month's webinar. So when we do send the survey out after today's webinar, I really appreciate it if anyone who's attending today could complete that and let us know, what do you want to hear more of? What do you want to hear less of? It really helps guide us in our upcoming webinars, because we're doing this to be able to help you as clients. And back to you, Stuart.
All right, thank you. So some of the key takeaways that we got from that, Andrew, and thanks, that was very in-depth. Fixed income yields are at their highest levels in over a decade. Used correctly, they can help manage the risk and return profile of a portfolio to meet, obviously, investors' needs. And the range of available fixed income investments is very broad, each with its own risk and return characteristics. Thanks for that, Andrew. It's very in-depth, and I'm sure there will be many questions. So if you have any questions, please feel free to post those now. Post them in the Q&A tab. Last time we ran this, they weren't coming through to me, but they were coming through to Andrew. If you haven't got any questions, please send those through now. I'm going to kick one off straight away, Andrew, and I'm going to ask you this. When adding some of these higher risk fixed income assets to a client's portfolio, how does that impact on the overall risk for the client?
Yeah, so we don't necessarily see these fixed income investments at the higher, so your Benthams, your metrics, and your US high yields. We don't see them as being a replacement for the traditional low risk, low return fixed income. It's more so a replacement for equity markets. It's what we're taking out of shares is what is effectively, or where that allocation's coming from. So what we're doing is, if we see that Aussie markets are overvalued and we want to pull 4 or 5% out of there, that's what's traditionally going into these higher risk fixed income investments. So what it actually means is we're still reducing the risk of the portfolio by doing it. It's not taking from that lower risk side of the portfolio. We're taking it from the higher risk assets to bring it down. So overall, it reduces total portfolio risk.
Fantastic. Now, I haven't got any more questions coming through on my end, Andrew. I don't know if you can see any up there.
Nothing else coming through. So
you must have covered it very well.
Possibly. Either that or everyone's fallen asleep as I talk about fixed income. Yeah. But look, if anyone does have any questions, when you get the survey, pop them in there, and we're happy to come back to you, or reach out to your wealth partner if you are an existing client. If you're not an existing client, please send an email through, and we'll have a chat.
Yeah, absolutely. So if you want to see how that's affecting your portfolio, or if you want to add fixed income to it, absolutely talk to your wealth partner about that. So look, I'll wrap that up. Thank you very much, everybody, for joining us for this particular webinar. We look forward to doing many more. And as Andrew said, please fill out that survey and let us know the topics that you'd like us to discuss further. Thank you very much for your time today, Andrew, and taking us through that. And thank you, everybody.
Thank you.